So welcome to this ShareSoc webinar with Sainsbury's. I'm pleased to introduce Mike Dennis, who is one of the ShareSoc directors, and James Collins, who is head of investor relations at Sainsbury's. Just like to hand over to Mike to give some introductory remarks.
Thank you, Alex. Yes, Mike Dennis here, Director of ShareSoc. I'll host you through the first part of this webinar and hand over to James shortly. Just before we go into a bit more detail, could you fill out the survey here, which will let us know how many of you on the line are already holders of Sainsbury's and how many are not? We'll just leave that open for a few seconds.
So we've had about 2/3 of people vote so far, and it's roughly 60% aren't shareholders and 40% are. Just leave that open for a couple more seconds to give a few more people a chance to confirm whether they're a shareholder or not. And I think most people have now voted, and we've got about 64% of people are not shareholders and about 36% of people are shareholders.
Okay, thanks, Alex. So if you can move on to the next slide, just the usual cautionary note that we're not authorized to give anybody investment advice. So this is it's up to you to make decisions on what you invest in your portfolio as usual. So just the usual warning there. For those of you who might be new to ShareSoc, just a very brief overview here on one slide of the kind of things we do with campaigning and informing and educating and so on. We are a not-for-profit membership organisation. We've got well over 6,000 members now and are growing at sort of double-digit rates every year. So you're all welcome to be members, and the more the merrier, because that gives us more clout in terms of dealing with the government and the regulators and any badly behaving companies that we may not be happy with. We do a lot of work on your behalf in that regards, a lot of it unseen behind the scenes. A lot of hours, hundreds of hours, go into making sure that we are negotiating on your behalf to ensure that there's a level playing field with the professional investors in the city. And there's still more work to do. And so do pay us your subscription fees. It's only 90 pence a week, and that goes to a good cause. None of the directors are paid. We're all volunteers. So all the money is spent wisely on your behalf. Moving on. Just some technical stuff about the webinar if you're not familiar with the technology. If you want to ask a question, type it in by clicking on the Q&A box. It's indicated there on the screen, and type away. We'll get through as many of those later on as we possibly can. Alex will be hosting the Q&A session as soon as the presentation is finished. A couple of other reminders. We have sent in the reminder emails already a link to a Stockopedia report on Sainsbury's. So do click on that and have a look. Quite useful background information. And we will post a copy of the presentation pack in the members area after this presentation. So you can go back and have a look at it again. And finally, and very importantly, do give us your feedback. There's a box in there that you can fill out some thoughts on what you thought about the presentation, what you think about the company and so on. All of that's really useful feedback for the company and for ourselves. So before you go, it only takes a minute. If you could give us your thoughts, please do so. You've already had an email with the link in it, and you will also find that the survey link appears when we finish the webinar at the end. Okay, so over to James. Welcome, James. It's great to see you here and talking to our members for the first time for Sainsbury's, and I hope not the last. And I'm very interested to hear how things are going. So without further ado, welcome.
Thank you, Mike, and thank you, Alex. And no, I'm really pleased to be doing this. I think it's a great initiative, and ShareSoc sounds like a really brilliant idea, because I'm all for as much engagement with investors as possible. So I'm James Collins, I'm the Head of Investor Relations at Sainsbury's. I've been with Sainsbury's for about 4.5 years. Prior to that, I was in the city as an equity analyst for about 20 years. So I'm somewhat poacher turned gamekeeper, and have worked in and covered the grocery industry for some years. If we can move on, I'll just do a brief introduction to Sainsbury's. So I imagine most of you have a pretty good idea of what we do, but this just gives a bit of a breakdown. So we have about 608 big box supermarkets, generally edge and out of town, around about 800 convenience stores, so Sainsbury's locals. We have online sales of around about 1.7 billion. That's grocery online sales. And those convenience stores generate nearly 3 billion in sales. I stress all of these are last year's numbers, so the full year to March 2020. A lot of those numbers would have changed pretty substantially into this financial year, and we'll cover that. Argos, which we bought in 2016, has around about 1,200 points of presence. So that's a combination of standalone Argos stores in shopping centres and high streets, some Argos stores in Sainsbury's, collection points in both Sainsbury's stores and convenience stores, and clearly a very substantial online business. Again, last year, around about 60% of sales started online, of which they were either collected in store or delivered direct to customers. And we are the third most visited e-commerce website in the UK. So after Amazon and eBay, it's a very, very substantial online presence. Nectar is our loyalty scheme, 18 million members. It's what we call a coalition scheme, so you can earn and spend points in places other than Sainsbury's. That makes it very powerful as a business tool and as a rewards tool. And increasingly, it's a digital business where we now have actually over 5 million customers who have Nectar on their phone. And that is something which will prove increasingly useful for customers and for us over time. We also own Sainsbury's Bank, and we'll talk about that a little bit later on. We have the 6th biggest clothing business in the UK, which is available predominantly in stores, but again, increasingly online. And we also own Habitat, which you should know is a well-known furniture brand. So moving on. What does that translate to in terms of numbers? So again, these are last year's numbers. So just under 32 billion of sales. You can see that grocery is around about 70% of that. So the bulk of that. Then general merchandise, so i.e. all non-food, excluding clothing, is the next biggest category. And then clearly a big fuel business alongside that. We are a thin margin business, so on that 32 billion of sales, operating profit of 938 million last year. That translates through to underlying profit before tax of just below 600 million. And from that, we generate, despite those thin margins, we generate very strong free cash flow. So last year, 600 million of free cash flow. Which we use to deleverage the business, so paying down debt and also paying a dividend. Last year's dividend payout, you could see, was low as a percentage of EPS. That's because we chose to defer a decision on the final dividend relating to last year, because we announced our results in April last year when we'd just gone into the COVID pandemic, and we were unclear what that would mean for our business. Since then, we've paid a dividend in lieu to actually make up for that final dividend that we didn't pay last year. So moving on, I will just run through what's happened to our business in the first half of this financial year. So for us, that runs from March to September. So clearly right in the eye of the COVID pandemic, and it's had a very substantial impact on our business. So typically grocery in the UK, or grocery sales in the UK, don't really grow very much at all, perhaps by around about inflation, 2 to 3%. Through the pandemic, you've seen far more food consumption move inside the home. So people are spending less time in restaurants, pubs, and eating out at workplaces, schools, etc. And so you've seen strong grocery sales over the period, so 10.5% in Q1, 5% in Q2. Clothing sales suffered, firstly because when people were in our supermarkets in the first quarter, when the UK was in lockdown, they were far more focused on just getting their grocery shopping done and getting out. But also because, frankly, people have not been going out as much, they've not been going out to work. Therefore, that's been driving lower demand for clothing. Worth saying that despite those numbers, we are outperforming the clothing market pretty substantially, again, helped by a very strong online performance. Perhaps the real standout for us in the first half of the year has been Argos, which has grown just under 11% over the first half of the year. And frankly, it's just been a very good performance. That's despite the fact for a large amount of the period we had to close all of the Argos stores and purely pivot to being an online business where people could have orders delivered to home, or they could collect in Argos stores inside Sainsbury's, which remained open. And so over that period, 90% of Argos sales actually started online. So it's the way the business has been moving anyway, with fewer customers walking into a store and ordering something and taking it away, and more customers ordering ahead and clicking and collecting or having an item delivered. So that drove strong general merchandise sales for us. And overall, that gave a good retail sales growth of around about 7% for the first half. So looking at how that then translated into operating profits, so retail sales up 7%, retail operating profit up 27%. So some really good operational gearing on those sales. That was diluted at the underlying profit before tax level by the fact that our financial services business, so Sainsbury's Bank and Argos Financial Services, dropped into a loss in the first half. And that's driven by a number of factors. So firstly, in terms of the business that we do, so lower lending volumes immediately means less profit that you book when you write new business. Additionally, we have a very big ATM or cash point business, which was lower year on year. And then third, we also have a very substantial travel money business. And frankly, the summer holiday season didn't happen this year. That's where we make most of our money. So a big hit there. And then the last impact is an accounting one where, because of the changed economic outlook, we, along with all other banks, had to take a more bearish view on future defaults or expected credit losses. And so that again drove the performance into a loss in the first half. But still underlying profit before tax up 26%. So moving on to just a few more numbers. So statutory loss before tax. Now that difference between the underlying and the statutory is some very substantial one-off costs that we took on the strategy update that we'll talk about later on, where we these are largely non-cash, where we have written down some assets, given some changes that we're making to the business. In terms of our retail real estate and some other areas around the bank and around logistics. But emphasising the fact that these were largely non-cash, our free cash flow performance was extremely strong in the half. So we always get something of a timing benefit where we always have a stronger free cash flow performance in the first half than the second half. But even year on year, it was up substantially. And that largely reflects the strength of sales, particularly at Argos, where all of our seasonal stock sold through very early and very well. And so that meant the net debt reduced by 912 million versus the year end. And as I say, some of that will reverse in the second half of the year, but we still expect to make good progress on net debt reduction. And as I mentioned earlier, we paid not only a normal interim dividend of 3.2p, but we also paid a special dividend of 7.3p, making up for the dividend that we didn't pay as the final of last year. So just looking at the kind of moving parts within that. So from last year's UPBT, obviously retail was a big increase, financial services down a lot year on year, as we deleverage, as we reduce debt, our interest costs are reducing, so that helps, and that gives you your movement year on year. And I think already I've seen a few of the questions that are coming through. There are some about what COVID has meant for us in terms of costs and benefits. And this gives you some idea. So you can see the numbers for the first half of the year. We had just over £290 million of additional costs associated with COVID. And this is primarily protecting colleagues, protecting customers, and particularly colleagues where we have not furloughed any colleagues, and we have paid for colleagues who have needed to shield or have needed to shield their relatives at home, or who have been unwell. And so that's been quite a substantial cost. And we've paid some additional bonuses, recognising the fact that our colleagues have done an amazing job putting themselves on the front line, frankly, in relatively risky circumstances. So that's been a big increase year on year. And again, some operating costs where if you go into stores, you will have seen that we've put in a lot more measures around hygiene, perspex screens around tills, queuing systems, all of these things, a very big change, and again, a big cost associated with that. And so there has been a lot of talk in newspapers about the fact that we've benefited from business rates relief. Well, we have, to the tune of 230 million of business rates that we haven't paid this year, or in the first half of this year. But as you can see, that didn't make up entirely for the fact that we had these COVID costs. And over the full year, we expect that balance to come a little bit more, to balance out a little bit more, but still we think that the COVID costs, particularly that we're looking towards more restriction for a longer time, will be higher than the business rates relief that we receive. So moving on to what happened net debt wise, so we have set ourselves a target that by next year we will have achieved 3 years, over 3 years, a net debt reduction of £750 million. Now, on our net debt, that means that we'll be going down from a number of around about over 2 billion to less than 1 billion, and actually towards that number from 1.5 closer to less than 750 million. But it's worth emphasising that with accounting standards, we additionally have a very large portfolio of leases, which from an accounting point of view are also treated as debt. So in terms of our overall leverage, we continue to reduce, and that's why it's such an important objective for us. So that's hopefully a brief whistle stop in terms of where we are from a results and balance sheet point of view. You may well know that we had a change of CEO this year. So Mike Coop retired in June and was replaced by Simon Roberts. So Simon, our new CEO, was formerly our retail and operations director. He has been with Sainsbury's for a little over 4 years. And prior to that, he had a career. He was managing Boots in the UK. And prior to that, spent his early years in retail with Marks and Spencer. So, so as is often the case with a change of management, Simon did a big review along with the rest of the board over the course of the summer of our strategy and key objectives. And so I'll also take you through some of the kind of key conclusions and the actions that have come out of that. And it's worth saying first out that it was an unusual and perhaps challenging time to do a strategy review, because in the midst of the COVID pandemic, our business was changing at a pace that we have not seen for a number of years. And from a digital online point of view, we've never ever seen change quite like this. So what these charts try and demonstrate is the degree to which digital has become a far greater part of the way that customers both need to shop through the pandemic, but now increasingly want to shop. So you can see that digital sales, so anything which is transacted outside of an interaction with a till or with a colleague at a till, over the period went from having steadily risen towards 19%, increased to 39%, so just under 40% for the year. Groceries Online sales doubled over that period. And so they, in the half, were 15% of sales, having previously been around about 7 or 8%. And they are now running at 18 or 19% and continuing to accelerate. So that's been a huge increase for us. And Smart Shop, another part of our digital capability, is the handheld scanners that you can use to scan your shopping and check out in store, again, without having to have your items scanned. Clearly a big appeal to customers during the COVID pandemic. Also very efficient, so moves people fast through the store, and additionally gives customers benefits in terms of being able to track as they spend. And so Smart Shop increased to 31% of sales over the half, and again continues to rise. Looking at what that meant for Argos, so Argos, was a majority online business beforehand, but now in the period you saw 90% of sales start online, so digital sales up 78% year on year. And even our clothing business, which has had a relatively small online business, now saw 18% of sales transacted online. And that's despite the fact that, unlike Argos, customers did have a choice all the way through of shopping in store. And so that's been a big boost for our online clothing business. And importantly, a huge amount of what we're doing, a huge amount of where we're spending our money and focusing our time and effort is on making customers safe and making customers feel safe shopping our stores. And so both in terms of, that's been a very, very big driver of customer satisfaction over this period. And you can see that customers have really recognised that in terms of their satisfaction with how our supermarkets have been performing. And again, online, we've doubled the business. Online has been challenged because a lot of the time customers haven't been able to get the deliveries that they want because the demand has exceeded the capacity for us to expand supply. But we have been expanding, and we have really focused that on, firstly, on elderly, disabled and vulnerable customers. That's something we did first, and we did very rapidly. And then focusing on our most loyal customers. So that again has been recognised by customers. You can see the dip where during that period where everybody wanted online and not everybody was able to get it, the customer satisfaction went down, but we've recovered, as has everybody, but we've maintained that that gap versus our competitors. So just stepping back again, that's the context. That's a very rapidly changing backdrop. But again, thinking about the strategy and thinking about how you get the most out of our assets. What are our assets? Well, the Sainsbury's brand, so it's 151 years old. It has a great heritage in terms of food and quality and a high level of customer service. That's what people expect of us. We have good scale. So we're number 2 in the UK in food, and we are the UK's biggest general merchandise retailer. Strong operating cash flow, as I referred to earlier, an attractive customer base. So we are, our store base is biased towards the south and southeast. Not that that's necessarily good in itself, but what it means is that it's higher population densities and higher wealth densities, and that fits with the brand. So we have customers who are able to trade up, and that's important in terms of generating more profitable sales. That sits with our store base, and we have a very strong convenience business as well as our supermarkets, where we've always been more focused on higher density, higher population locations. And increasingly, a huge asset is the fact that we have invested heavily in recent years in our online and digital capabilities. That's clearly come to the fore in the first half of this year, where you've seen that big increase and you've seen good operational gearing because we've had the platforms to be able to deliver that growth. And increasingly Nectar is a powerful asset across all of both grocery and increasingly Argos, where we've now put Nectar into Argos. And So if you take that asset base, you take the transition that's happening in terms of the way customers shop, we established 5 key priorities, and the top 3 are the ones that I'll focus on today. So firstly, food first. So it may sound obvious to a business that has a majority of grocery sales, but we do think that we will benefit from a tighter focus back on our core food business. We recognise that we can be better in terms of value and in terms of innovation, and we are confident that we can improve both of those by buying better from our suppliers and reducing our cost to serve, so reducing our cost base. Brands that deliver is looking at the brands outside of the core Sainsbury's brand, so Argos, Sainsbury's Bank, 2 Habitat and Nectar, and again, just more of a focus that they absolutely have to deliver predominantly in supporting the core food business, but also in their own right. So a much tighter focus on making sure that those brands earn their keep. And then save to invest. Cost savings are a regular feature in terms of the UK grocery industry. It's a tough industry with thin margins, where we're constantly on very strong cost savings programs to reinvest back into the proposition. We think we can do better, and the objective that we've set out is to reduce our operating cost to sales, so our operating efficiency, by 200 basis points. And that's a real step up in terms of the ambition within the business. So moving on, what changes? So I think this is something that Simon's been keen to emphasise. So where food has been part of the portfolio of brands, and we have been investing, I think quite rightly, and focusing on how we get the most out of those brands together, I think that we can benefit from a simpler approach and from a tighter focus on food. So I think our resource has been perhaps too thinly spread, and the message is that we think we can do better back on the food proposition. And again, it supports that message around the other portfolio brands. Cost savings, as I said, have been a feature of the business, but we've had a tendency to be very good at achieving cost savings, but also to incur cost increases elsewhere in the business. It's a different ambition to say that we will have a structurally lower cost position. And also bias to build, moving to partnerships or outsourcing where necessary, just recognising again with a tighter focus that we don't need to do everything ourselves, that we can do some things better with partners. And the outflow from all of this, the intention is to move from an earnings performance, which has frankly been a bit disappointing, so weak, kind of a small but steady erosion of margins, towards a more robust profit delivery, while still maintaining good, consistent, dependable cash flows. And what we've promised to deliver is talking to 7 key metrics every time we report to the outside world, and a much greater linkage of those to incentives, where I think it's been relatively opaque historically. And looking at those metrics, what are they? So on the operational front, customer satisfaction, that's ultimately where everything flows from. Strong colleague engagement, so that again is huge in terms of really being able to deliver the operating standards that that customers expect of us, and net zero, so an increasing focus for us across all of our business is looking at the footprint that we make, not only in terms of carbon, but in terms of a wider raft of impacts that we have across both environmental and social aspects, and even additional characteristics such as healthy living. So what we can do to promote more healthy eating across the UK. On the financial front, profit growth. So inevitably that's where we'll be focused, and we think that we can do better on that front. Grocery market share performance, where ultimately the changes that we're talking in terms of value and innovation, we expect to derive a better grocery performance. It's a tight market, but a better market share would help. We talked about the reduction in operating costs, And really importantly, the upshot of this is a strong, dependable retail free cash flow. So that £500 million a year that I talked about earlier, which if you look at the cost of our dividends, if we pay a kind of relatively steady dividend, then that would be around about 230 to 250 million pounds a year. And so that is only half of that free cash flow. So what that tells you is that that would enable us to deleverage, so reduce debt and pay a good, consistent, steady dividend. So moving on just to some of the detail of this. So delivering better value, and clearly it's always got to be a focus for a business like ours. We do have a great reputation for quality and service, but what the customers tell us is that we can be more consistent in terms of value. Now, it doesn't mean that we need to drop prices across the whole of the business. Actually, we are very pleased with where our price position is compared to our key competitors. However, what we do know is that there are some items where we are not as close as we need to be to some of our key competitors, or not in line with those key competitors. And so there's a really strong focus that you're seeing come through with our price lock activity on specific items that are really important to customers, really important to driving perceptions, and really important to driving what we call halo spend. So if you get the price of chicken breasts right, if you get the price of mince right, then not only have we seen a really strong volume response where we've corrected those prices, but also you see a halo where, because customers are buying those items with you, then they will tend to shop the wider basket with you. And we know this, we can see this in terms of what customers are including and not including in the basket through our Nectar data. So it's quite sophisticated work, it's quite targeted work, it does involve investment. And as I said earlier, we're confident that through cost savings elsewhere in the business that we can finance that, as well as clearly expecting a better grocery performance to help pay for that as well. Innovation is the other thing that we believe that we can do better. So ultimately, this is one of the areas that the Sainsbury's brand really used to be a long way away, a long way better than our big four competitors. So we used to be much more bracketed alongside Sainsbury's and Marks and Spencer's in terms of new products coming through, innovation, new and interesting product. And frankly, we've fallen back into the pack. There hasn't been sufficient focus on this. It is important for customers across the piece. So whether it's on more premium and interesting products, whether it's across organic, whether it's across healthier products, whether it's across meat replacement, there are huge areas where we could do better. And so what we're doing is committing to tripling the number of new product launches, speeding up the product development process by a third, which helps. And we will do that by expanding our innovation team in-house. So it's a really important focus for our business in helping drive growth. And Groceries Online, I talked about it earlier, it's a really, really important bit of our business. So having gone from 7% to now pushing up towards 20% of our business, the key thing here is to make it as efficient as possible. So in short, we do not make as much, we are not as profitable online as we are with groceries in store. So effectively what that tells you is that where we do charge an online delivery cost, it doesn't fully cover the incremental cost associated in terms of us picking the order and delivering it to customers. So firstly, click and collect is moving to be a much bigger part of the business. So it went to 20% over the first half from 3% previously. That's a more profitable outcome for us because the delivery drivers are clearly a big part of the overall cost. But overall, in terms of the expansion of Groceries Online through this period, it's been a very good outcome for us in terms of the profitability. So we've increased our orders per van, so the amount of single customer orders going out per van by 35%, and those orders have been on average 17% bigger. So if you think about the amount of actual groceries going out per van, That's increased by more than 50%. It will increase further because we've now extended our delivery slots to go earlier in the morning and later in the day. So huge productivity improvements, big step up in terms of profitability. And the other big driver of the economics of online is items picked per hour. So this is how efficiently our colleagues are picking orders off the shelves and collating them. We know that we are at the leading edge of the industry on this, and really satisfyingly, despite all the challenges of social distancing and the fact we had to hire a lot of inexperienced online pickers over this period with the expansion, we're now back to where we were previously in terms of items picked per hour. So, so it's been a great period, a fantastic operating performance, and we are confident that we can keep on improving the productivity in terms of Groceries Online, and that's really important because when we emerge from COVID and the restrictions that it's put on the way that people want to and are able to shop, we are confident that online will still remain a far higher proportion of grocery sales than it has been historically. It may not quite stay at these levels, but it's very important that we are as efficient as we can be on that front. So moving on to Argos, we announced with our results in the strategy update, a very big change in terms of the Argos footprint. So recognising the change in the way that customers have shopped, where now around about 90% of sales are done either online and delivered to home or online and collected in stores, we are changing our store footprint quite substantially. So we have around about 500 standalone Argos stores. We will reduce that over the next 3 years to around about 100 standalone Argos stores, so on high streets, retail parks, etc. They will be replaced by around about another 150 to 200 collection points in Sainsbury's. So these aren't Argos stores in Sainsbury's, these are where you can go, you can order and choose to collect an item in those stores. But we will also additionally add up to another 150 Argos stores in Sainsbury's. So around about 75% of the Sainsbury's supermarkets will have an Argos store inside. So we will still have around about 1,000 points of presence across the UK. And frankly, the feedback that we get on customers using Argos stores in Sainsbury's and using those as pickup points is incredibly strong, because the stores are open longer, there's free car parking, and if you're starting online anyway, customers really appreciate the convenience of that. So we will still have as good a geographic footprint, but we will clearly be doing that at a far lower cost, having taken 400 locations out of the footprint. We will also be improving availability, because part of what we will do in terms of maintaining the network is adding 30 additional big dark stores that will hold stock close to where customers want it. So increasingly, there will be more items available for customers to pick up from store or have delivered to home within 4 hours. So it's a big transformation. We talked about it saving around about 105 million pounds over the next 3 years, but it also delivers a better customer outcome as a result. And those are some of the key things covered here. So that £105 million profit improvement, but also a working capital benefit. With fewer locations, we will have less stock sat inside stores, and it will be a much more on-demand model. And alongside that, so the improved availability we talked about, and then we can also lower prices. So moving on to financial services, so the bank and Argos Financial Services. So there has been a bit of a press coverage of late about what we might be doing in terms of Sainsbury's Bank. We have had some interest from third parties on the bank, so we are looking at that. But really important to say that we laid out a new strategy for the bank with a new management team last September. And the bank has frankly been disappointing for us in terms of returns. That aims to really turn around that performance, and we are now delivering on that. So clearly COVID is a challenge, to that in terms of the economic impact. But despite that, we are seeing really good performance. And so just running through quickly what those targets were, we are still on track despite the impact that COVID will have on the business. So firstly, no more cash being put in from the group into the bank. And that's a really important principle. And we still think that ultimately the financial services business should be able to return cash to the group within the 5-year period that we talked about. We expect to double profits and double returns. As I say, return cash. We'll do this in part by reducing the cost base substantially. We stopped offering mortgages, and we're now aiming at a stable balance sheet rather than growing lending, and focusing our efforts increasingly on the Argos financial services business and connectivity to Sainsbury's through the credit card. So a much tighter focus, and we think a more profitable one with higher returns. And we've made great progress on that front. And talked about the third key priority being safe to invest. So this slightly complex chart, the line shows you that operating costs to sales, so the burden of operating costs on the business over time has been increasing steadily, despite the fact that we've been achieving good cost savings. You can see that we've increased our ambition in terms of those cost savings, and a lot of those will come from areas that are unique opportunities to us. So a replatforming of our logistics and supply chain, raising more than 150 million in terms of cost savings. The Argos replatform we've talked about with 105 million, and some significant areas such as changing the way that our stores operate, including the closure of some of our meat, fish and delicatessen counters, where these are all tough decisions, but they're tough decisions that we think are the right ones to take money out of some operating areas to put it back into the areas that really matter to customers. So this is really about creating firepower to invest back in the areas where we can improve our proposition, particularly across the grocery business. And then ultimately, what does that deliver for shareholders? So we said a profit inflection. So we have been seeing this steady erosion in profit. We're now talking about the fact that next year's profit will be higher than 1920. And it's a slightly complicated way of giving guidance. But ultimately, this year, we've already said that profits this year, in the year to March 21, will be at least 5% higher than last year. But a lot of that is driven by some of the exceptional demand around COVID. So on a normalised basis, what we're saying is that profitability from next year, even if that falls back from wherever this year's number heads to, that will be higher than last year. So versus, if you like, versus a sort of base normalised year, this is a more profitable business that should come out of this strategy update. And the commitment is that we will keep on growing profits thereafter. In terms of capital, so we are spending more money to achieve the Argos transformation and the big change to the logistics and infrastructure changes. However, we are, as I said earlier, committing to 500 million of free cash flow on average over the kind of 3 years. And where we are spending money on those projects, they are very high returning. So paybacks within 2 years. So very, very good high returning spending of money before we'll then see a normalisation of capital expenditure to low levels. And likewise, one-off costs, there are some big one-off costs associated with this, largely non-cash. But again, where we're spending the cash, again, it's on these high returning projects. So what does that deliver? We're still on track to deliver the net debt reduction by March 22, 500 million average free cash flow thereafter, and that gives you a very sustainable, well-covered dividend. So hopefully that's given a good summary in terms of the results and the key points of the strategy. I will now hand it back over to Alex for some Q&A.
Thank you very much, James. Yes, we're going to take your questions now. We've had a few questions come in ahead of time, and we've had a few questions during the presentation. Just as a reminder, if you do want to ask a question, please just type it into the Q&A box at the bottom of your screen. Now, James, we have had a lot of questions here, so we're going to try and go through them quite quickly. Let me start off with a couple that have come in ahead of time. To what extent can the first half performance be continued into the second half?
Okay, so when we published our results, we said that the second half had started strongly, both in terms of grocery and general merchandise sales. I think it's fair to assume on grocery that the UK will remain in some form of restriction. It looks like until the spring of next year, which is when our financial year ends. So I think it's fair to assume that there will continue to be an elevated level of grocery consumption inside the home. Where the outlook is less clear is for Argos and general merchandise, because economically, these are more discretionary areas, and that has been really strong whilst consumer incomes have been protected and spend has been focused on the home. But I think we are more cautious in terms of the outlook for Argos for the second half of the year. So it started strongly, but we would be more cautious in terms of where that goes in our fourth quarter, which is the first calendar quarter of next year.
Okay, thank you. Now looking at digital, how big a proportion of sales could digital get to, and what are the implications for your overall store footprint?
Yeah, so we talked in the first half about digital being 40% of sales. So I think I would be surprised if that is maintained into next financial year, assuming that we do come out of the other side of COVID. So I think it'll drop back a little way, but I think pretty soon we will see it back at those sort of levels. In terms of what it means for the store footprint, the great asset we have is the fact that we pick all of our online grocery from our stores. So that means that we get fantastic gearing out of the box. So if you think of the fixed costs that we have in our store base, we're not entirely ambivalent as to whether customers shop groceries through the front of the store or the back of the store. However, we will flex the way the store operates over time. So if more of the grocery sales are going online and through the back of the store, we can reduce cost and perhaps the footprint of the front of the store. So almost as if the back wall to the warehouse is moving. And that is far more efficient than going out with dedicated online picking. So it's a big fixed cost for us where we get very good gearing. We are making some changes to the store footprint, but I think that it will continue to be pretty minimal in terms of the grocery, of the big box grocery stores, because they can and are very effective. They are very effective for delivering online grocery.
Okay, following up from that, supermarkets are traditionally low margin businesses. Are any of the changes to shopping habits and the move to more digital mean that industry margins are likely to improve?
No, at the moment, the shift to online grocery is actually a margin challenge for us, because, as I said earlier, we don't retrieve all of the costs that we charge customers on online delivery. That doesn't entirely cover all of the costs associated with online for us. However, as we put more volume through our online business, that gap has closed, and hence, one of the things that I think we needed to reassure the market on with this statement and the strategy update was, despite this big step up in online, we're confident that we can still grow profit, despite the fact that we continue to expect that accelerating. So, over time, we will make more changes to the way that people shop in the front of the store. We can become more efficient. Customers will become more digital and more inclined to use self-scanners, to use handheld scanners, to use their mobile phones, all of which, again, takes cost out for us. So there is a bit of a balance there. But at the moment, I would say that is more of a margin challenge for us than an opportunity. Okay.
Jumping across now to Sainsbury's Bank. Question here is Sainsbury's Bank sufficiently profitable for the future? given the disruptor's success in recent years, and as a business in which investment is imminent?
Yeah, it's a good question. So I think the main reason why the bank is not making acceptable returns right now is that the UK banking industry has changed fundamentally. I think that's ultimately at the heart of that question, where a lot of the business lines that we would have been growing over time as we built a bank of scale have become far less profitable. So we are subscale in that, and that's what we've recognised. So that's why we are now no longer growing balance sheet and far focused on a tighter business with tighter returns. And if we deliver on our plan of doubling profits, doubling returns, then that gets us to an acceptable level of returns for the bank. But clearly our ambitions are very different from the much bigger bank ambition that we had a number of years ago.
Okay, looking at product pricing now, what is the basket price differential between convenience stores and mega stores?
So it's a good question. So one thing actually, which I don't think anybody necessarily knows, is that all of the UK supermarkets operate national pricing. So across all of our superstores across the UK, you'll find the same pricing in every single store. But as the question recognises, there is a premium in convenience stores. And that's because the operating costs for us of convenience stores are higher, the rents are higher. And ultimately, we find that customers do recognise that it's still very good value relative to other convenience operators, so particularly relative to independent stores. So you will find a large amount of the items in the convenience store are matched to superstore pricing. There are some products where we have a premium, and that premium would rarely be above the sort of mid to high single digits percentage above the standard superstore price. And where you'll find actually increasing success, both in terms of a better customer offer, but also in terms of profitability for us, is in terms of the range of products. So you will find quite a different range of a Sainsbury's local store in Knightsbridge than you will find one in a more sort of urban housing area. And that is increasingly a skill that we have, is making sure that range is right for customers.
Looking at your competitors now, do you foresee any change of strategy from Asda as they enter new ownership?
Yeah, it's very difficult to predict. Ultimately, grocery retail is not complex. There are a limited number of levers that you can pull in terms of kind of range, price, service, quality, etc. I think that there would be speculation that Asda would try to be more price competitive. The biggest issue that Asda has, more so than the rest of the UK big box grocers, is the discounters and the fact that they face them in more locations given their geographic bias. But frankly, already Asda is seen as the most price competitive of the UK superstores. So I think it would be a very bold move for them to make a big shift pricing wise, because I'm not entirely sure, or I think that there will be a low level of confidence that they would get a real return in terms of being able to drag more customers away from the discounters. So ultimately, the new owners of Asda need to make a financial return in the same way that the previous owners would. So I think you're unlikely to see particularly radical change from the new owners. Okay.
Moving on to COVID now and the government support that you've received during the pandemic, do you foresee any pressure to repay the business rate relief or suffer a windfall tax if you produce good figures? Noting that Tesco have received critical press following the announcement of an intended special dividend after the sale of their Far East business, and this isn't even through organic earnings.
Yeah, so it's a complex picture, this one. Yeah, you're right. Not only Tesco, but all of the UK supermarkets have attracted some criticism for the fact that while we have been if you like, thriving. We've been taking or receiving business rates benefits. I'd say the press coverage is limited to a couple of titles who are kind of particularly focused on this story. And likewise, if we look to some of the noise coming from Parliament, again, it's a small number of individuals who are on this bandwagon. I think it would be very difficult for the Chancellor to firstly reverse this, because there's a number of issues to take into account. Firstly, business rates. I think there's an increasing acknowledgement that business rates is a pretty unfair tax. Despite the business rates relief this year, we will pay less business rates than Amazon. We'll pay more business rates than Amazon. So increasingly, it's an unfair tax on all retailers relative to online. So it's in our view not a right form of taxation for retailers anyway. Secondly, if we look to government, all of the UK grocery CEOs are regularly engaged in conversations with the Prime Minister and the rest of government on what we can do to help consumers right now, because ensuring food supply is critical. Ensuring food supply, particularly over Christmas, is really important, and ensuring food supply to elderly, disabled and vulnerable customers, which we've prioritised, is incredibly important. So I think that kind of narrow view that we've been thriving is perhaps unfair, particularly in light of the costs that we've incurred. And then the second thing is, where do you draw the line? Because it's not just grocers who have been seeing strong sales through this. So if you look at B&M, if you look at Kingfisher with DIY stores, if you look at Halfords, there are a huge number of retailers who have been receiving business rates benefit and have been reporting profit growth. So I think it's unlikely that you see a reversal of that policy.
Okay. Looking now at your environmental commitments, is the route to net zero by 2040? Is the reduction in carbon emissions evenly spread? And if not, when are the main reductions expected?
It is pretty evenly spread. So it's one of those classic things where often people ask us about programs like cost savings and say, so what are the big things that you will put in? And there are a huge amount of small things that need to be done in order to reduce that footprint. So clearly, there are some very big areas, transport being a huge one, refrigeration being another. But again, you don't achieve those changes overnight. A lot of what we will achieve is by working with our suppliers. So working with refrigeration suppliers, working with fleet suppliers, and working, frankly, with our suppliers of food and non-food and general merchandise products to go beyond scope 1 and scope 2 into scope 3 reductions. So it is pretty evenly spread over time. I think there inevitably will be some big wins, particularly if you look around some technologies around refrigeration, around transport. There will be some big wins, but even then, if you think about for example, changing refrigeration units across more than 1,400 stores, that's not something you do overnight. So I think we have committed to reporting twice a year on our progress. At times, I think we fully acknowledge that we won't necessarily be moving 100% in the right direction on 100% of goals all the time, but I think we will be making steady progress across the piece.
Okay, I'm going to combine a couple of questions here, which are on a sort of similar topic around click and collect and online. And what percentage of delivering click and collect orders are still being fulfilled through manual product assembly in the branch? And will there be opportunities to use more automation or robotics in food picking for online in the medium term? And are there further efficiencies to be had in scheduling for online food deliveries?
Yeah, so that's a big question. So firstly, right now, we have one dark store, so one store which just services online, and that's in East London. And we built that because we were worried a number of years ago that we wouldn't have the capacity within our London stores to service the amount of demand. But frankly, we've become so much more productive in terms of our in-store picking that we don't anticipate needing any more of those. So right now, pretty much close to 100% of our picking is done manually in the back of stores, manually in stores by colleagues. Worth saying though that when we say manually, it's not the equivalent of you walking through a store and doing your produce, doing your dairy, doing your meat, going and getting your drinks, and then walking out the door. It's done in a much more consolidated, efficient, very tech-driven way, with all the orders being consolidated to reduce the amount of time and distance spent by the pickers. So it is an incredibly efficient process. Will robotics change that? There is potential. Right now there are a number of operators selling robotic solutions. So far, we've not been convinced by the economics of any of them, largely because they can't service the whole range. So we have about 40,000 grocery items. At the moment, those robotic systems, maximise them out to around about 15,000. So there just isn't the efficiency to pay for that at the moment. So I'm sure the technology will get better, but at the moment we don't see that. And then delivery slot pricing, we are doing some very clever things around delivery slot pricing. So I'll just tell you one initiative of what we've done in the last 2 weeks, which is that we've introduced a £1 online grocery delivery slot option. It's £1 because you don't get to choose a 1 hour delivery slot. You can choose a 4 hour delivery slot. And then we text you that day to tell you which 1 hour we'll deliver in. It's a great efficiency solution for us because it means that we can fill the capacity where we want it. So it would typically fill in the flat spots. So it's very good from an efficiency point of view. And also obviously for customers who have the flexibility of being able to choose a 4 hour window, then obviously it's a far better delivery price.
Okay, we've got time just for a couple more questions. So apologies, because I know we're not going to get through all the questions today, but we've got time for just a couple more before we finish this webinar. And here's a question on pricing. What impact do you expect from the erosion of price levels and market share by competition from the likes of Aldi and Lidl?
Yeah, so I think, frankly, the evolution of Aldi and Lidl or their impact on the UK grocery market, which has largely been through new store growth over recent years, has frankly already played out in terms of industry margins, and the industry margin response has been seen. The industry pricing response has been seen in the margin evolution from the last sort of 5 to 6 years, where you've seen margins reduce for most of the major players, and you've now seen a much more stable picture. Why is that? Because I think we've all of the big box players, us included, have found the most effective way of responding to the discounters. And what you're seeing now is the discounters come under more pressure in terms of their own growth and their own margins. So Aldi, who publish margins, for example, their margins are their profits are around about half the level they were 5 years ago, despite substantially higher sales and substantially more investment in stores. So I think in terms of the discounters' impact on the industry, will they continue to be a pressure? Yes. Will they be transformative to industry economics in the future? I don't think so. And in part, A, because we found a good way to respond, and B, because a large part of their influence on the industry came from the fact they expanded their product ranges. In doing so, they've made their own model less efficient. They've limited their own economics. And so I think as and when Aldi and Lidl have more opportunities to put their capital in other countries, I think you will see less new capital put in the UK.
Okay, Anna, we've got time for this one last question here. And as I said, apologies, we haven't been able to get through all the questions today. Was any customer feedback taken to inform the decision to close meat and fish counters? I just wonder whether this is losing something valuable and something that attracts customers to Sainsbury's.
Yeah, it's a really good question and a very pertinent one. So firstly, we've seen the feedback most obviously in the fact that our counters business has been declining to 10% year after year after year. So fewer customers are using those counters. That doesn't mean that no customers like the counters. And so alongside that, we do listen to customers. A huge amount of the strategy development time has been spent by talking to customers. And we also can see from Nectar data, we know exactly who uses the counters, how they use them, when they use them, what they substitute, what happens when the counters aren't available, which has been the case through COVID. And so COVID has given us actually some, if you like, some live experimentation time where, because we had to close our counters for operational reasons, we could then see, as we moved a lot of that product into the aisles, we could see what happened in terms of customer response. And so, it is clear that you will not have 100% of customers happy as a consequence of that decision. But we are convinced that the equation of taking a lot of cost out of something, which was frankly very unprofitable for us, and putting that back into the offer elsewhere, and putting a lot of those products back on the main shelf, we think that that's the right balance.
James, thank you very much for those answers and also for a very comprehensive presentation. I'm now going to hand back to Mike Dennis, who's just going to say a few final words.
Yes, thanks, Alex, and thanks, James. Excellent presentation, a good, so lots of interest, and we'd love to get you back, James, in a few months' time after the finals. Actually, I'm sure we'll get an equally busy audience with plenty of questions. But just before we go, just a reminder, the presentation and the recordings will be on our website. So if you want to go back and have a look at anything and remind yourself, it will be there shortly. Do provide your feedback so that we can understand what your first impressions are of a presentation from Sainsbury's. And just a reminder, we've got a few more webinars and other events coming up in the next couple of weeks, and just a list of those there. I think the Equis Exchange one will be interesting. First time I've heard from them, and that's tomorrow. And we've also got a shorting stocks masterclass for those of you who do a bit of shorting in your portfolios. And as you can see, a whole range of other companies, and through to Lloyds Bank on the 9th of December. So keep an eye on our events webpage. There'll be more being posted every day, so we're trying to keep you busy. And for those of you who want to go to the after meeting and talk about Sainsbury's in a bit more detail and share information you may have and what you've heard today, that meeting will start almost imminently. So those of you who want to join, you've already received an email. So just click on that link and that will get you through to a Zoom meeting, which will be hosted by one of our Signet members, and enjoy that as well. So just remains for me to say, enjoy your day. Thanks again to James and Alex for an excellent webinar, and I look forward to seeing you all soon. Bye for now.
Bye, and thank you very much.